Ladies and gentlemen, good day and welcome to Alicon Castalloy Ltd's earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mayank Vaswani. Thank you, and over to you.
Thank you, Yashaswi. Good morning, everyone, and thank you for joining us on Alicon Castalloy Ltd's Q4 FY2024 earnings conference call. We have with us on the call today Mr. Vimal Gupta, Group CFO, and Mr. Rajiv Gupta, Head of Domestic Business of Alicon Castalloy Ltd. Mr. Vimal Gupta will cover the operating highlights and financial performance for the quarter, following which Mr. Rajiv Gupta will provide insights on the domestic business as well as developments in the global markets. Thereafter, we shall open the call for the Q&A session. Before we begin, I would like to point out that some of the statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings documents that have been shared with all of you earlier. I would now like to hand over the call to Mr. Vimal Gupta for his opening remarks. Over to you, sir.
Good morning to all our investors. Thank you for taking the time out to join our earnings call on a Saturday. I trust that all of you have had a chance to review our earnings documents, which were shared earlier. We are delighted to report the highest ever quarterly revenue for Alicon in quarter 4. Further, with revenues of rupees 421 crores in quarter 4, we have surpassed the milestone of 400 crores in quarterly revenues for the second successive quarter. This has been driven by efforts to develop capabilities for and serve new technology platforms in the auto industry, expansion into new geographies, renewed focus on value engineering and capability augmentation, and has been supported by positive trends in our established business line. In prior earnings calls, we have conveyed to investors to closely track the following 3 themes that underscore Alicon's business transformation for insights into our progress and evolving business model. We continue to increase the share of passenger vehicle PV and commercial vehicle PV in our product mix. This has reached to 52% of sales in FY24 compared to 49% in FY23. Secondly, our customer profile is evolving with the addition of prestigious global names, including leading global OEMs and Tier 1 companies, highlighting Alicon's growth stature in the industry. Thirdly, our business composition is shifting towards expertise in design, research and development, and value engineering. Alicon now distinguishes itself by winning business based on innovation, technology, and design, positioning us in a solution provider rather than just a source of low-cost components. As we continue to adapt and innovate, these themes serve as a key indicator for investors to assess our ongoing transformation and strategic direction. Now turning to the financial performance for quarter 4 of financial year 24, total income reached to rupees 421 crore, that is a 31% increase compared to rupees 321 crore in quarter 4 of FY23. When compared with total income of rupees 406 crore in quarter 3, this indicates sequential quarter growth of 4%. Revenue growth has been driven by scaling up of production for new parts and new logos added recently, including many critical parts being supplied to multi-customers. The gross margin for the quarter was 54.1% in quarter 4 financial year 24 compared to 51.6% in quarter 4 23, higher by 250 basis points on year-on-year basis. This is primarily due to the improving product mix and accompanied by positive impact from the stabilizing of alloy prices at lower levels. There has been a sharp rise in employee costs, which are higher in quarter 4 by 33% on year-on-year basis. About one third of this increase is due to the increase in minimum wage and new hires in line with operational growth. and incremental production. The larger part of the increase is due to the impact of the ESOP cost of around 3.6 crore for the quarter and 14.4 crore for the full year period, which is a non-cash charge. Shifting our focus on profitability, EBITDA for the quarter 4 was rupees 59 crore, as increase of 78% from rupees 33 crore in the same quarter of the last year. The EBITDA margin for the quarter 4 FY24 has improved to 14% in comparison to 10.3% in quarter 4 of FY23. After absorbing the sharp rise in employee costs and increase in other expenses, I am pleased to share that we have reported an improvement in the EBITDA margin by 370 basis points on year-on-year basis and by nearly 100 basis points on quarter-on-quarter basis. Finance cost was higher by 27% on year-on-year basis from 8.6 crore to 10.8 crore, in line with the increased borrowing and higher interest rates. We also witnessed an increase in the depreciation, which was higher by 25% on year-on-year basis from 16.7 crore in quarter 4 last year to rupees 20.9 crore in quarter 4 of FY24. The increase in depreciation has been driven by addition of new assets as well as leasing some machines which have been adjusted over a period of maximum useful life of 5 years as per prevailing accounting standards. Thirdly, we re-evaluated and shortened the useful life of some other assets, which has also contributed to increase in the depreciation. Despite higher finance cost and depreciation, PBT has increased by 2.5 times from rupees 8 crore in quarter 4 last year to 27.4 crore in the quarter 4 of FY24. Profit after tax for quarter 4 FY24 was rupees 20.5 crore as compared to 9.7 crore in quarter 4 of FY23, higher by 112% on year-on-year basis. On a sequential quarter, profit after tax was higher by 23% from rupees 16.7 crore to rupees 20.5 crore. For the financial year 23-24, total income was rupees 1,563 crore as against 1,405 crore in the corresponding period last year, growing by 11% year-on-year basis. The gross margin for the full year was 51.5% as compared to 49.2% in FY23. EBITDA for the financial year 2024 stood at rupees 199 crore against 157 crore in FY23, higher by 27% year-on-year basis. Some of you would recall our prior earnings call, where we had indicated that we will increase the EBITDA margin by 100 basis points in FY24. I am pleased to share that we have improved the full year EBITDA margin by over 150 basis points to 12.7 in FY24 from 11.2% in FY23, based on our reported numbers. We continue to remain confident about the upward direction in margin given the improving product mix. There was a sharp increase in the PBT, which increased by 31% year-on-year basis from rupees 62 crore in FY23 to rupees 81 crore in FY24. Due to the tax adjustment in the prior period caused by the shift from the old tax regime to the new tax regime, the increase in profit after tax for the financial year 24 was 19% year-on-year basis, as it is increased to rupees 61 crore against 51 crore in the last year. In terms of CapEx, we have spent around rupees 30 crore during the quarter 4 and aggregate of 114 crore during the financial year. This is largely due to machinery for production as well as the investment into new product development and for our maintenance capacity. Given the heightened level of activity at present, this is slightly ahead of our target CapEx deployment of around 90 crores indicated in the start of FY24. Coming to the outlook, looking ahead, we envisage revenue growth of around 15% in FY24-25, which result into total income moving from 1,560 crore in FY24 to around 1,800 crore in FY25. This is predicated on the healthy pipeline of SOP from the new product and the new customers. Further deferment of volumes during FY24 will now contribute to the revenue in FY25. Thereafter, we are poised to take the business to newer heights as we aim to deliver a revenue of over rupees 2,200 crore by 25-26. This equates to a CAGR of over 15% over a period of 3 years. Our confidence stems from the new orders which we have received and discussions with the customers on new technologies and solutions. We believe we have a strong runway for growth as passenger vehicles penetration in India is still very low at 32 units per 1,000 people, whereas China has reached a level of 223 units per 1,000 people, or 7 times of India. Countries like Germany, Japan and US are at penetration level of that is 20 times than that of India. Thus, India will remain a strong growth market for a while, and other countries will offer opportunities that are a combination of growth and replacement. In addition to the above growth of the vehicle market in India, it is estimated that by 2030-31, the split of passenger vehicles will be 60% of ICE, 25% hybrid and 15% battery electric. This indicates that the ICE remains relevant and will continue to grow. Hybrid also provides a compelling opportunities as does the EV or carbon neutral opportunity. Alicon is in sweet spot as it is well positioned with high content per vehicle in all 3 technology verticals. Even as indications remain that 4W growth will be substantial, we are also excited by the opportunity ahead for commercial vehicles given the projected spend on infrastructure and the trends in urbanization. To give you a glimpse of how we are already capitalizing on these opportunities, I would love to share that we are witnessing a significant traction EV volume and are engaged in crucial projects to boost our production capabilities. For example, the e-Axle prototype we developed for JLR, we will enter mass production this quarter from our plant in India. This product has enhanced our technological capabilities and enriched our know-how in offering thermal solutions. The market is also shifting towards hybrid technology, and I am pleased to report that we are leading this transition. Our cylinder heads for Toyota are designed specifically for their hybrid model, reflecting our advanced position in this technology. As hybrid technology gains broader acceptance, we anticipate further volume increase. OEMs like Maruti are also embracing this trend. Our strategic focus on future-ready technology and innovation has positioned us ahead of the curve in EV space, and we are now applying the same approach to hybrid. Additionally, our concentration on critical components, particularly in the EV sector, has allowed us to secure significant contracts, setting us apart from competitors in this segment. We also anticipate further traction from global customers such as Dana, Mahle and Tenco, even as domestic two-wheeler customers are showing initial sign of revival in demand. In addition to the growth from the increased volume and therefore revenue, we also expect to deliver an improved margin profile. We have already mentioned our aspiration to take the EBITDA margin to around 14%, which we have already delivered in Q4 of financial year 24 itself. Lastly, we are looking to drive efficiencies across the balance sheet and in working capital, which will contribute towards enhanced return ratios too. On that note, I would now like to hand over to Mr. Rajiv Gupta, who will talk about developments in the domestic business and share highlights for the global business.
Thank you, Vimalji. Greetings to all of you. In Q4 FY24, auto dispatches for the domestic industry showed an improved performance, especially the two-wheeler segment, which witnessed healthy double-digit YOY growth. This includes 10% growth in the passenger vehicle segment in Q4 on year-on-year basis, 26% growth in the two-wheeler segment on year-on-year basis, and 1% degrowth in the commercial vehicle on year-on-year basis. Within the passenger vehicle segment, there is clearly dominance of UVs, with both customer interest and market share steadily rising. Importantly, we are witnessing a trend where customers who were on the fence with regard to purchasing of EV now considerably shifting to hybrid or ICE vehicles. This is starting to positively impact demand for traditional products. In Q4 FY24, the retail volume of commercial vehicles saw a marginal decline. We believe this is largely due to a shift towards higher tonnage trucks, resulting in increased payload capacity but impacting the volume of LCV and MCVs. Further, two-wheeler trend to witness a pickup in volumes ahead of the election, given the on-ground activities required to be undertaken across the country. The outlook for two-wheelers is expected to be positive in FY25 too, as traction is shifting from EVs to ICE products. Coming to some of the key business programs this quarter, for Maruti, as indicated in the prior quarter, we witnessed ramp up in the volumes during the quarter as one of the cylinder heads we supplied moved into startup production. Further cylinder head for another model completed a validation stage and is set to go in SOP in Q1. The volume for both cylinder heads combined will provide significant volumes increase in FY25 from Maruti Suzuki. Further, we will also be supplying to their Gujarat plant next year. With respect to the supply of cylinders to Stellantis, which commenced in Q3, it has now moved into mass production in Q4. As we had indicated, these will be for domestic market and will also be assembled and exported to Europe. Stellantis is seeking to create an engine manufacturing hub in Hosur in India, and Alicon is a single source supplier of the cylinders for those engines. As anticipated, volumes have shown an initial pick up in Q4 and we are set for a complete ramp up in FY25. The outlook for two-wheeler volumes is also increasing, and with election expenditure combined with outlook for a normal monsoon indicates that the rural demand may sustain. In that light, we anticipate that our key two-wheeler customers will increase their requirements. While we have indicated a focus on portable business and higher value-added products, we remain steadfast in enhancing volumes in the two-wheeler in order to sweat our assets and operate our installed capacities at optimum levels. We also see some revival in momentum of the non-auto with the increasing spend of the government, infrastructure and defense, and the renewed vigor of Make in India campaign. As you may be aware of the last several years, we have been supplying aluminium wheels to enable lightweighting of the battle tanks. With a healthy level of demand witnessed for our products catering to the defense sector, we have added 2 parts for the wheel to be supplied over next 3 years. These pertain to regular size tanks as well as for the larger tanks, as we have indicated in last quarters. In the global business, we have shared that the prototype of an E-Axle Jaguar Land Rover was approved and supplies were ramped up in Q4. which has contributed toward the upward momentum during the quarter. The production of the battery housing of Jaguar Land Rover is also progressing well, and the production at the Alicon facility was at the peak volume during the quarter. For Daimler, we have a significant long-term package under development which was added in quarter 3, for which we expect approvals in quarter 1 and quarter 2 this year. Supplies are set to commence from 2026, continuing until 2035. Thereafter, we have added further orders in quarter 4, FY24, comprising of 6 parts from Daimler. With these developments, the global business contribution to 28% of the total revenue during the quarter 4, which is significant improvement compared to 21% of quarter 4 last year. For the full year, global business was 25% during FY24 compared to 22% in the prior financial year. The share of international business is set to improve further, as during the quarter 4 we added 12 new parts from 4 existing customers in the quarter. This includes 2 parts from the carbon neutral or EV, 2 parts from the non-auto, and 8 parts from the ICE. Of these 12 parts added, 2 parts pertain to the domestic business and 10 parts is for the global business. The new business added is in line to a strategy of a higher value add, as 94% of the business added in quarter 4 pertains to 4-wheelers. On the geographical basis, 94% of the new business added during the quarter is for the global market. For the full year, we have added 50 new parts from 17 customers. Here too, in keeping with our strategy, as 95% of the business added in quarter FY24 for the full year 24 pertains to 4-wheeler. On the geographical basis, 85% of the new business added during the full year is for the global markets. Globally, prominent customers such as Dana, Danfoss, Taco, Mahle are set to scale up the volumes. Further, we have noticed an increase in number of inquiries from global customers, and we see buyers from US, Europe indicating interest to source larger quantities of products from Alicon. There is a clear shift in the minds of global customers, and we see increasing recognition of Alicon as a partner and customer of choice for critical parts in their upcoming projects. Our recent success is with one of the global OEM, where we were able to produce a key part for them with a unique solution in a reliable and cost-effective manner, enabling them to avoid large investments required under the traditional approach. This solution will aid them in enhancing the performance of the vehicle. These successes enable creation of the partnership beyond that of simple supplier relationship, which creates opportunities to participate in the future projects. In terms of operating landscape, we see normalcy returning in Europe. Electricity and gas prices are stable, and availability has also improved. In terms of raw material, aluminum prices have been less volatile than in past. During the quarter 4 24, Alicon has booked new orders aggregating rupees 150 crore. With this, our total new order booking has touched to 9,150 crore, which is executable over a period of 6 years from 2023-24 up to 28-29. On this note, we can open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Raghunandan NL from Nuvama Institutional Equities. Please go ahead.
Thank you so much for taking my question. Congratulations to the team for a wonderful set of numbers. Vimalji, Rajivji, thanks so much for the opportunity and congratulations. Sir, firstly, to Rajiv sir, if you can share the segmental mix for FY24, two-wheeler, PV, CV.
Yeah. So coming to quarter 24, for the full year, for last year, the total sales, if we talk about contribution, around So, two-wheeler was 40% of the total pie, passenger vehicles were 33%, commercial were 19%, and non-auto were 6%.
Got it, sir. And sir, when we look at exports, roughly would CV, PV be 50-50 in exports? What could be the broad mix?
Somewhere same figures, but we'll review and get back to you on this.
Thank you. And what would be the EV share, sir, in FY24?
EV was 12%.
Wonderful. Thank you so much for sharing that. And in terms of the revenue outlook, if I heard it correctly, 1,850 crore for FY25 and 2,200 crore for FY26. Would that be right, sir?
For 25, it is 1,800 crore.
Okay. And the new orders to be executed as highlighted. So Maruti, JLR, Toyota, TSA, Dana, Mahle. These would be the main OEMs, sir, driving the new order execution?
Then Danfoss.
Danfoss as well. And ESOP, sir, for FI...
Then the growth of the two-wheeler also, that is going to support.
Got it. In two-wheeler, any major OEM, sir, from whom order inflows have been strong?
So mainly that the drivers, you'll see that this Honda motorcycle, so they are growing very well, and you must have seen that they have surpassed the numbers of Hero.
Correct, sir.
So yeah, we are the almost single source. Approximately, we are supplying 88 to 90%. Our share of business is there. So there it will grow, and Hero is also growing because in the maybe in the pie not, but overall numbers are growing. So they are approaching, and we are seeing the good inflow of the orders. Means the numbers, the order will be increasing month-on-month basis. There is increase in the volume from Hero also.
And particularly from Honda, the content per vehicle is larger than other OEMs, and that's a good sign where the Honda volumes are increasing. This year also they are talking about more than a double-digit growth. So that's a positive sign where we are working to materialize in this financial.
And would it also include the new EV of Honda, because there again content will increase for you?
In this financial, there's only marginal numbers at the last quarter. But as mentioned, we don't intend to enter in that segment as the opportunity with the two-wheelers is very less, which I've explained in previous calls. The content per vehicle for aluminum in a two-wheeler is less, and where we have mentioned that we would like to shift to passenger and commercial.
Got it, sir. And sir, for ESOPs, it was 14.4 crore in FY24. What is the expectation for FY25?
It is around 4 crore.
Got it. And given that for margin outlook, if I take for FY25, There is some increase in freight cost because of Red Sea issues. There is some aluminum price increase. Would you expect all these to be passed through, and we should be able to, say, sustain 14% or increase from here?
Yeah, these are the freight is always a pass-through cost. So maybe like you have seen for 23-24, our overall full year margin is around 12.7%. So that I was explaining because now our target is to reach 14%. Actually, we were targeting to reach cross 14% by 25-26, but now we are expecting that maybe in this year, full year, we will hit this 14%.
That's wonderful to hear, sir. And CapEx, what would be the expectation for FY25, and what would be the areas of spend?
So mainly that now this year we will have a bigger CapEx. So approximately at this moment the estimation is around 150 crores. So the main reason is that now we have to build up the capacities for the new order, especially for the EXL. The major part will go to the JLR EXL capacity building up, because only the common machines are very less. So these are the bigger parts, bigger machines, then their quality requirements, their processes. So and then we have to build up the capacity for the PSA, because it's almost robotic lines we have to put. And then these are the mainly for the new projects, as well as then maintenance capex is there. Then we are more focused, because if you have seen our P&L, I have also explained the manpower cost, because major hit is coming especially in the Maharashtra for on the minimum wage side. So there is a huge increase that we have seen in the last year also. Again, we have seen some increase in this year already started. So the focus is coming to for the automation. So now some part of the capex we have kept for the automation of the processes to control to bring the cost of this manpower under control.
Understood, sir. Thanks so much for giving that explanation. And what would be our capacity in tonnage terms, sir?
Capacity utilization you are talking about, or the total capacity?
Utilization is around 70%, as you mentioned in the presentation. But would it be right to look at capacity in tonnage terms, or that would not be meaningful?
Around 50,000 plus, we can say like that capacity.
Got it, sir. And last question to Rajiv, sir. Rajiv, sir, would you have the machining mix for FY24?
Yes. So machining 26. Which year?
24, sir. FY23-24, sir.
So 61%.
61%, and this should only increase, right, going ahead?
Yes, when it is, because the as cast only we are doing the two-wheeler cylinder head. All other products, maybe some parts for the four-wheeler cylinder we are doing half machining, but whatever the business we are adding, that is fully machine parts.
Wonderful, sir. Thank you so much. Best wishes, and I'll come back in the queue.
Thank you, Raghu.
Thank you. We'll take our next question from the line of Jyoti Singh from Aryan Capital Markets. Please go ahead.
Yeah, thank you for the opportunity. And Vimal sir and Rajesh sir, congratulations on the good set of numbers, and also executing order in a decent way. So just wanted update on the order book side. What are targets going ahead? How we are, targeting to execute till 29, and also how big is the opportunity in Maruti? Only we are supplying cylinder head or any other part also? If you can update. Thank you.
So till the time Rajiv gives the explanation about the order book. So for the Maruti, first we have started the cylinder heads, right? And that is a very big opportunity, I say, because that at this moment this is only a start. So one model we are supplying to them, and second is almost now we have got the validation. So that will be a ramp up we will see in this year, and new model they are coming up. So maybe I think they are developing for the hybrid. So that is going to be a really what we see that major breakthrough for the Maruti. So they will announce shortly. So where also hopefully we will have the that cylinder head with Alicon. So that is a big opportunity on this side. For other parts, maximum parts they are doing the high pressure. Some parts they have approached us, so we are in assessment that what parts we can do. Like already we are doing some engine mounting brackets and maybe some manifolds or some other parts, the structural parts. They have approached us. So at this moment we are assessing that how we have to deal with it. Maybe in the next quarter we will come out with the what finally we are going to do with them. And now Rajiv is going to explain about the order book.
Yeah, further to add on the Maruti, we see a good opportunity with the hybrid acceptance by the customers. Like you are aware that we are supplying and we are single source for the Toyota two models, 1.5 and 2 liter. So this same platform will go to the Maruti Grand Vitara and Invito. So there we see a good volume generation, and together they are working on a lot of hybrid models. So we see an incremental volumes for the existing volumes going forward. So that is again a good addition for Alicon. Now talking about the order booking, yes, it is going quite well. In last year also we have achieved sales of around 97-98% of what we have planned. So roughly around 770 crore we have booked with the order bookings what we have planned, and this year we are aiming to do a sale of around 1,200 crores from the new business. The momentum is going good, as I've stated in past also, like whatever additions we have done till date. So around 83% of business is from the four-wheelers and around 56% is from the global customers, and in this total chart around 22% is also from the non-auto. And even if I split the hybrid, it's more than 8% in a hybrid on the order booking what we have generated. So this means we are touching all the avenues so that we can take leverage of all the segments going forward. And the order booking, we have now clear booking of around 9,150 crore from 23-24 to next 6 years till 28-29. So there also we are strong on execution and utilizing the orders what we are in and converting to sale.
Okay. Thank you so much, sir.
Thank you. We'll take a next question from the line of Yash Dalal from Sushil Financial Services. Please go ahead.
Yes, hi. Firstly, congratulations to the management for reporting your highest ever quarterly revenues for second successive quarter. My first question is, what is the volume growth in Q4? Because revenues have slightly increased this quarter, whereas EBITDA margins have risen to 14% from 13% last quarter, if we don't account for ESOPs and one-time expenses. So what is the fall in realization this quarter due to raw material price fall?
So raw material prices actually that the improvement in the margins is due to that I explained that two reasons. One is the change in the sales mix, and another is the settlement of the alloy prices, because in the quarter 4 those were on the lower side. So that is the reason we can see that the improvement in the margins. So major driver is that the sales mix, what we say. And we have started some new parts like JLR prototype we have started. So those supplies were there.
Okay. So also you mentioned that 1,200 crores for FY25 is coming from the new business. So the old will come down to 600 crores. Is this mainly because we've dropped the noise parts?
Ideally, all the products have a life cycle, depending upon how the model is accepted by the industry or by the consumers. But yes, some is end of SOP, some is the customers are working every time with new technologies, upgrading their models. So that also is contributing. And second is, yes, with the direction where we shifted our focus and leverage to passenger and commercial.
Okay, thank you. Just a couple of more questions. So also there is an 8 crore written off. What exactly is that, and is it one time?
So these are the some receivables, old receivables. So maybe we already provided earlier, so but only written off in this part. And these, because we are running a big business of maybe now we are talking about 1800 crore sales. So it is not going to happen that only there will be zero write-offs or anything. Maybe some small amount will continue, but it is a business, so I cannot commit, okay, it will be zero, but I cannot say that it will be 8 crore, maybe it can be 2 crore, 3 crore. So it is a part of the business.
Okay, thank you. And just the last question, what about your technology of friction stir welding? By when should we start seeing the benefits of this new technology?
This will happen in the quarter 3 of this year. So ideally, yes, we were little aggressive. Even our customers were aggressive with this model, but some changes in the model they have executed. So with that, we're expecting this to differ by a quarter. But yes, we'll start supplying some samples in quarter 3 and thereafter ramp up in the next year.
Okay, thank you so much.
Thank you. We'll take our next question from the line of Aditya Chheda from InCred Asset Management. Please go ahead.
Hi, thank you for the opportunity and congratulations on great numbers. My first question is on the subsidiary business. We've seen a significant improvement. If you can talk about how the business has been in subsidiary business, and how do you see that moving forward as we have a healthy growth rate? If you can share some outlook on the subsidiary business, that's my first question.
So for the subsidiary business, that maybe in this year we have seen a good growth, and maybe in the current year also 23 or 24, 25 definitely we will have a good number. But there are two reasons for this growth. One is that for their existing business, so that is growing because especially like battery housing for the Samsung that goes to JLR, or some volumes from the two-wheeler like KTM and BMW. So all these volumes have gone up. On the other side, that the development of our JLR product is also happening in Europe, so in Alicon. So that sales has also booked in 23-24, and maybe because some this year also we have supplies of the prototype casting to the JLR customer. So in this year also we see this the good numbers for our company Alicon in Europe. But the coming year, so we should not expect the big growth because we just want to use that place for our as a development center, as an engineering center. So because like for this product we have hired technical people from the Germany, designers, tooling, all these things. So we are more focused how to use the technology from the European supplier. Those engineering is available from Germany or some other countries. So that is the base. So when we talk about the numbers, to converting the numbers, so I don't think there will be a big jump in the coming year in Europe. So that because this definitely this business will shift to India, and the mass production will happen in Alicon, India.
Yeah. So basically the intention is if any new technologies in the market, they hit first Europe, US, China, and we see a lag after 2-3 years it comes to India. So the idea is to become be early in that market. So we use election model that way. And that also supports to our customer when we are very close when we talk about global regions. So and second is we see there are a lot of development experts, good technologies across Europe. So we also it's easy for us to get those know-how. So a lot of learning we have added with this development, and yes, we have noticed we have got a benefit of sales in quarter 3 and even, in quarter 4, and some will definitely add in quarter 1. But going forward, our intention is any large volume or mass production better keep in India so that even customers get the benefit of the cost.
Right. Thank you. My next question is on the machining capability. How much are we outsourcing as of today, and whether incremental volumes would require more outsourcing, and whether that impacts the margin overall, if you can comment something on the machining capacity, outsourcing, etc. Thanks.
For the machining, approximately 60% is in-house and 40% we have outsourced. And now we are building more in-house the capacities, like because some customers those are coming with the new parts, so they look for the in-house machining. So generally, due to their quality requirements and the control on the product, so in-house capacity building will be more in the coming years. So that's the reason, one of the reason for increasing our capex in this year.
Right. So we are expecting this mix to remain at 60/40, or because we see a very high growth.
In-house will increase.
Okay.
But we will try to, because whatever we are doing in-house, if something we can outsource, because we need the consent from the customers also.
Right. Great. These are my questions. Thank you.
To de-risk the capacities. Otherwise, maybe some volumes are down, so our all in-house capacities utilization will go down.
Right. Thank you. That's it from me.
Thank you. We'll take our next question from the line of Chirag from White Pine. Please go ahead.
Yeah, thanks for the opportunity. So just one question. Your gross margins even sequentially have seen a significant jump and the single largest reason of EBITDA margin expansion. So if you can just elaborate a bit more on this, it would be helpful, because suddenly what happened in Q4 that the value added happened. So, and is it a normalized gross margin for this should be the base for FY2025, or how should we look at it?
Generally, gross margins are driven by many variables. First is that the sales mix, how it is moving, that which parts, then the processes on this product like machine parts or raw castings. Second is important factor is the aluminum prices also. Like if what we are seeing that upward trend in the aluminum prices, maybe in the last 2-3 months we have seen a 8 to 10% increase in the prices. So then it will definitely will increase the material cost percentage to sales. And on the other side, if we see that there is an increase in the volume of the raw casting, especially the two-wheelers, because we are seeing a good jump in this year of 24-25 in the two-wheeler also. So that is also going to drive this our gross margins. So, but what you are saying that in this year it is a good where we have seen the very this improvement in the gross margins, but maybe I think that will establish between 48 to 50%. Means the margins between 52 to 50% in that range. That will move.
Okay. You are saying on annualized basis it should be in the range of 50 to 52%.
Yes.
Okay. So, but sir, what happened in Q4 specifically? Because YOY I understand, even Q on Q there is a sharp jump in gross margin.
As I explained that the sales mix, so some big volumes we have supplied where our gross margins are higher. That we have supplied to the customers, and another is that I'm saying that in this quarter the aluminum prices were at the lowest.
Okay. Or is this the impact of any year-end negotiation or conclusion with respect to your pass-throughs from OEMs? Because generally we have seen your Q4 margins tend to be significantly better, gross margin. So is there any, like, whatever hike you were expecting from your OEMs get settled in Q4, and hence this is a general phenomena?
No. Very small impact, because it is there but not so big, because generally, for the aluminium, what we have seen that 60% aluminum buy is already settled by the customers. So they finalize the price with the suppliers, they allocate the suppliers, so and the settlements are on month-on-month basis. And for other customers also, they do on quarter-on-quarter basis. So this happens, what you are saying, that when the settlements are on yearly basis, or they delayed the quarterly basis, maybe it is set on quarterly basis, but they are not doing, they are delayed for 2 or 3 quarters. So in that case, this happens. But generally, I have not seen such kind of impact.
Okay. And so one last question, you indicated that you are putting it a huge 150 crore capex this time to add new machining capacities for different type of products. In the order book that you have today and future order book that you are anticipating, would you be needing any similar huge capexes given that different type of products would come in and or this is now for next 2-3 years it will be again normalized capex?
So this year is the biggest capex we are going to have because we have to build up the infrastructure. You know that when we are going for the high volume for this JLR and PSA. So one is that only increasing the machines, the capacities, and another is the complete installation of the infrastructure, the technology. So in this year we are doing this like when EXL or for PSA infrastructure installation is there, but after that when volume will grow, so we have to just add the machine this casting capacities or maybe just increase our, because in this like take example, for a year they talk about 100,000 pieces. So I cannot put up the capacity for each process of 100,000. Maybe one capacity I have to put maybe 200,000 because it's not possible to do that. So later on when we increase the capacity from 100,000 to 150 or 200,000, so I have not to put the complete infrastructure. So only just balancing, I have to balance the capacities for each process.
Okay, thank you. Thank you very much and all the best.
Right. Thank you.
Thank you. We'll take a next question from the line of Anirudh Shetty from Solidarity Investment Managers. Please go ahead.
Hi. Thank you for the opportunity. I had 3 questions. So my first question is, we are seeing a lot of traction in the global markets, and we're growing at a pace at much faster than the Indian industry. So wanted a sense of which are the large competitors that we have, or who are the biggest competitors in the aluminum casting business, which countries really dominate this industry, and if you can talk about some of the +1 tailwinds that we're seeing, whether it's from China or from Europe or more outsourcing. Just want to understand what is driving this strong traction that we're seeing.
Okay, talking about the global competition, there are competitors, but those are segment-wise. There are specific firms who are into four-wheeler cylinder manufacturing, like JN is there, then NEMAC is there, then Montopo is there. So many more are there in that segment. But with Alicon, what is one of the USP with Alicon is we have a variety of parts, and that differentiates us with other competition where, today OEM are working into multiple technologies, be IC, be hybrid, or be EV, or look for a structural part. So they they're also aiming to reduce the supplier base, because that's the cost. Adding a supplier is a cost for them. So that's the reason for long term they're looking for partners who can give solutions into various verticals. And also they see the strength of that supplier, how much is the capacity, how much is their experience in this industry, how early they are with technologies, and how much is their presence globally. So these are again the plus factors which support us. Yes, we also notice some customers are shifting from China and they are opting to India. Even recently we are noticing customers are shifting from Thailand to India. So that also is a new thing which we are noticing. So we are ready for that, and for customers also to approach is very easy because you have seen a customer base, big, large of customers we have already delivered few parts in past. For them also to add or to interact is very easy. So we are ready for that, and we are looking to materialize those opportunities which we are getting recently.
So in this mainly that Alicon is the largest foundry in India as an independent foundry, because all other major foundries, those are an umbrella of the OEMs. And also the observation like Rajiv has shared that we are seeing recently that the sourcing of casting, aluminum casting is shifting from China, from Europe, from US and to India. And the first choice what we are seeing that the Alicon first. Because maybe, and we are the not so big company as per the requirement globally. So that is a big opportunity what we are seeing opening up for Alicon in the coming future. As well as when we are talking about what you have asked about the competition. So in India, as a independent foundry, we are the largest one. So competition is less because all others are an umbrella of OEMs and they're supplying to their parent companies. And at the global level, our share is very less. So there is no meaning at this moment saying the competition. Then when we become a large company and then the big supplier at global level, then the question of competition comes. So whatever we are getting the businesses and the OEMs, so that they are shifting the sourcing. So these are the big opportunities what we are seeing here.
Got it. And just a follow-up question on this, right now globally there's, there's a cost pressures that were, there. Everyone would want to work with a good quality but also low-cost players. So when we benchmark ourselves to, say, a Chinese player or a player from the Europe, US, what is the cost difference for us versus them?
There is a cost difference. One is the little we see on the aluminium, as they are the largest producers of aluminium. And second is, yes, they are also offering to large scale. But with Alicon, one is we are this industry since long and we work with customers since inception of the design. So during the design, we see if we can reduce the weight of the part so that we can pass on some benefit to our customers. That is one way we play. And also as we are into multiple processes, like we are into gravity and low pressure. So we evaluate during design stage which process will give a better result in terms of productivity or better results in terms of speed. With that, we submit a proposal and customer is accepting. And third is our partner, Enkai Corporation, who is also having plants across 19 countries. And they're also in this industry since long with the same process. So continuously we get upgraded with the support. Even our team members frequently go to their location, they come down to our location, and continuously we are upgrading our operations so that we support to our customers. So with that, even customers are now preferring us over Chinese. It's the combination and more is about the volume game, what we can support to our customers.
This is one part that one is that China, maybe can't say that we are very much competitive against China, but there's some political reasons they are shifting to India. On the other side, when we talk about the Europe and the US, so this is not only the cost side, the only cost benefits they are having and shifting to India. That is the one of the factors of the cost, but they are also seeing the challenges of the supplies from their local suppliers, like the quality, the volume, because the existing suppliers, they are not ready to increase their capacities, maybe to the financial, whatever the challenges they are having. So these are the main factors for shifting that Alicon is able to supply the volumes, we are able to supply the quality, and then we are able to maintain with the required stock and maintain the just-in-time supplies to all their requirements. So these are the major benefits they are having when they look for the supplies from India as well as from the Alicon.
Got it. And just one final question is, we want to over time increase our return on capital employed to 20%. You've already explained your EBITDA margin trajectory. I just want to understand the balance sheet size, the balance sheet metrics a little better. How do you see the asset turns, at what asset turns and at what net working capital days do we kind of hit this 20% mark?
So mainly that asset turn definitely now, because one is the existing capacities, because immediately for the existing, so we cannot change. Maybe some improvements in the productivity that can happen, but for the new product like we are explaining, where we have the high value, means the high weight of the crafting, high value addition. So that is giving a good asset turnover ratio in the coming business, whatever we are adding. So this asset turnover gives a slow growth. It cannot jump from maybe I'm at 1.8 or 2, so suddenly next year I will see a 3. This is not going to happen, but slowly it will improve year-on-year basis. We'll see that growth on the because when we are talking about the ROC, so ROC major driver is that how we are controlling. One is that definitely from this side because controlling the investment. Second is more focus on this part of the margins and the working capital. Maybe you must have seen that year-on-year we are reducing our number of days working capital, and hopefully in this year also you will see the further improvement because we are more focused how to reduce our inventories, and now because we are seeing the growth in the exports, so how to reduce our debtor days, receivable days. So definitely in this year we'll see a further improvement in the working capital cycle.
Is there any number that we have in mind in terms of target ratio that we want to target on the working capital?
So maybe 8 to 10 days, because I think we are near to about 78 days in the net. I'm not having the data correctly, but I'm just the idea that based on we are distributing this. So maybe I think 7 to 8 days, so at least we are targeting further reduction in this year.
Got it. Great. No, thank you so much for answering my questions. I appreciate it.
Thank you. We'll take our next question from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Yeah, sir. Thank you for the opportunity. My question is with respect to this PV clients, which is Maruti, Kia, Toyota, Stellantis. What kind of incremental business is expected based on the schedules that you have for FY25 and FY26? And what was it in FY24? Just for me to understand and corroborate with the 15% top line growth number that you have shared.
So yes, for this financial as 24-25, we see an opportunity to grow with the passenger vehicle segment. So around PSA will give us 50 crore.
You can give combined, it's okay. I don't want customer-wise. I want a combined number if you have that. That's also okay.
So roughly around 180 to 200 crores we will get with Maruti, PSA, Toyota, and also global customers. The parts what we added recently like Mahle and Daco.
Okay. So this is incremental?
Yeah, this is incremental.
And in FY26?
FY26, further to this, Jaguar will be added. Like this year also, Jaguar, the e-axle what we developed, and another part, a battery tray again for the Range Rover EV. That will go into sample submission and queue for validation. But major ramp up will come in next year, and that would be adding around 150 crore addition with this. And further, we are expecting another cylinder head from Maruti to add in ongoing ramp up in next financial, followed by some additions with existing customers like Danfoss.
So you are saying 180 crores in FY25 incremental, and then another incremental of 150 crores in FY26. That's how it is, right?
So in 25-26, further to this will be a domestic customer PSA, which will go into ramp up at the peak.
So actually, I tell you that when you are going to make a comparison with the 23-24, so approximately the incremental at this moment, because from the big numbers we know, because of existing customers will also grow. So 200 crores we are seeing that incremental from there, and approximately 500 to 550 crores in the 25-26. From the base of 23-24.
So what is 23-24 number for PV? In the 1500 crore top line, how much is PV?
We're talking about the PV.
PV would be around 44%. Sorry. Yeah, it's 44%.
44%. So to this number, incremental 500 will get added. Now I don't understand, sir, what you want to highlight actually.
Actually, we have also not understood.
No, really, sir, you mentioned about a lot of increment of lot of these programs from different customers. So I wanted to know incrementally, or let's say point to point. Now, if 44% of your business today is PV, so in 1,500 crores, 44% is fresh car, which is let's say closer to about 700 crores business. The 700 crores business will be added by another 500 crores over the next 2 years by virtue of whatever clients that you have.
Just a second. You don't get contribution, no?
So I'll tell you, this year our PV was 39% of the contribution, and two-wheeler was 32%. Next year PV will grow to 40. I mean this year 24-25 PV will go to 44%. So a big jump we will see with the additions of the parts like Maruti, PSA, Toyota, and even Jaguar we are talking. And thereafter, in 25-26, PV will touch to 46. Another 2% will add with ramp up of the Jaguar Land Rover and other customers.
So what you are talking about is a 5% jump as a contribution from the PV. So that translates to approximately 100 crores. And in 26-27, that jump is 7%. So 7% that translates into approximately under 150-160 crores.
Okay. And so one second question on the margin side. So when your mix changes, is it neutral to your margins? Is it detrimental? Is it superior? How does it play out? Both in gross margin and EBITDA?
No. That the sales mix change because, mainly we are more focused to bring whatever the new businesses we are adding up. Those are mainly from the four-wheeler side. And so where definitely the margins are on the higher side. So that is happening. And that is the reason that is giving a improvement in the quarter we have seen that the improvement in the margin.
Okay. And on your capacity utilization side, you mentioned that you are utilized at 65%, right?
Yeah, around that, yeah.
And what is the maximum that you can use your assets? Is it 85?
If we do that maximum utilization, that can go up to 85 to 90% because, the 10-15% we have to keep for the volume fluctuation. But this never happens because this will move in this range, maybe 70-75%. Because, some in one quarter, maybe one customer goes down, another customer goes up. So it is not like that is we are running on the same line. So we have different lines. So one line utilization is more, when we are talking about 70, maybe one line is having 90% utilization, maybe another line is having 60% utilization. So totally depends on the customers, how they are behaving.
So when you add your revenue from whatever growth rate that you have mentioned at about 15%, so basically you will end up in the next 3 years adding another 700, 800 crores of business, 700 crores. So for this 700 crores of incremental business, what is the capex that you will do?
700 crores, the additional maybe approximately, I think, 250 to 300 crores in that range will go.
This will include both maintenance and growth capex?
Yes.
Okay. Thank you very much, sir, and have a great day, sir. Thank you.
Okay, thank you.
Thank you. We'll take our next question from the line of Rohit Suresh from Samatwa Investments. Please go ahead.
Good afternoon, sir. Thank you for the opportunity. So my first question is, so recently there was an interview by the CEO of Jaguar. That they're planning to scale down their EV volumes and focusing more on the hybrid part. So do you see how will that impact our overall Jaguar orders? Because if I'm not wrong, you're supplying e-axle as well as some battery housing to the EV part. So what will be the impact, and are we also supplying any parts to their hybrid vehicles right now?
Yes, even we see this traction coming up in the EV vehicle, the pure EV, which they have launched, not just Jaguar, but from other global and domestic customers. We're noticing this shift, and this is also a point which we are taking up with them aggressively, because these big parts are having huge investment, and that's the reason first thing we got to support is to do investments phase-wise. Traditionally, investment was to be put 100% and then we need to make it ready. But for this scenario, they have understood and they also agree to do investment phase-wise. And second thing is, at Alicon, we can produce, in one machine we can produce variety of parts, be a ICE, be a IC, be a EV or be a hybrid. So our machines are universal. So that de-risking also we do, and we map very clearly. If volumes are fluctuating, definitely we have a ways to shift the capacity to other projects.
So, but the difference, so what my understanding is, for the EV part, we are doing e-axle, we are doing battery housing, those are critical components, right? So for the hybrid, what, apart from cylinder heads, are we doing anything else, or is it purely cylinder heads right now?
Purely cylinder heads, other engine parts, and more is a structural part where we have opportunity. Like for Jaguar, it's a subframe, very critical part tradition. Subframe are very critical part of high weight to support a big portion in the vehicle. So there also we supply a lot of chunk. For Jaguar, all the models we supply the subframe. So there also we see the opportunity to grow with this customer. But yes, hybrid also we see that we have good traction. And second is, even customers knows our strength in this area, and they also are easing to leverage this opportunity.
Got it. Sir, on your order book, I had a couple of questions. So, if I'm not wrong, of the 9,000 crores on order book, around 30% is in the EV segment, right? So, how much of that will be, if you could give me customers, so how much will be Jaguar and a top 2-3 customers mix? Hello.
I need to just see customer wise. I don't have the data handy. I'll tell you.
Okay.
But I'll tell you the major one is Jaguar, yes. That would be compromising to around 10 to 15%. Then it's Toyota, then it's PSA, then it's Maruti, the big ones when we see among the list.
So what I suppose that, okay, maybe you can be in touch with us directly, because so much granular information details at this moment is not available with us. So we can talk about that. You can either approach to CDR or directly to us.
Got it. Sir, and on the non-EV part, so what is our focus? I guess, so there are a lot of parts that we are doing in the non-EV part. So what will be our key focus areas in the non-EV part? So will it be non-auto? Will it be structural parts? Some understanding on that?
Yeah, on the non-EV, one is the A-class part where we focus. One is the cylinder head, which is a good opportunity, and one is cylinder head for domestic as well as the global market. Second is similar, which is going to the hybrid variant cylinder heads. Then a lot of engine parts also we supply for the global market where we get good volumes. So that is also an area where we focus. Then is the structural parts, which we have just mentioned in the last speech. And then is for the commercial we supply good chunk. Right now is also around 20% of our sales from commercial. So major is from the global market where we see good volumes. One the engine, second is also the radiators of a truck, which have the requirement is of a cat tank, which is made in our process. So there also we have a good volume. So there are ideally 4 players in this market making those cat tanks, and we are associated with all 4 customers in that segment. So there also we see a good volume. And second is a big customer, Daimler, which we have noted in our previous calls also. So the new development, we are participating actively with them. And the recent engine what they have just developed, which is from 26 to 35. So we got this opportunity to develop all major parts of the engine in aluminum with them. So that also we added recently.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to the management team for closing comments. Over to you, sir.
Thank you. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call, and we look forward to interacting next quarter. Thank you very much.
Thank you. On behalf of Alicon Castalloy, that concludes this conference. Thank you for joining us, and you may now disconnect your line.